Every year, millions of Americans make one of the biggest financial decisions of their lives. Not where to work, not what car to buy, but where to put the money they'll spend decades earning. Some choose real estate. Others choose the stock market. Both sides are convinced they've made the smarter decision. Real estate investors often say, they're not making any more land. Stock investors respond, the greatest companies in history have always rewarded long-term investors. Both arguments sound reasonable. And that's exactly why this debate has lasted for generations. The problem is that most people never compare these investments the same way. They'll compare a home's appreciation to stock market returns, while forgetting about mortgage interest. Or they'll compare the S&P 500 to a home's purchase price, while ignoring leverage. Some people forget property taxes. Others ignore dividends. Many never account for maintenance, insurance, inflation, closing costs, or the opportunity cost of tying up tens of thousands of dollars in a down payment. Leave out just one of these variables, and the conclusion can change completely. So instead of asking which investment has the better reputation, let's ask a better question. If two Americans started investing today, with the same amount of money in the same 30-year time horizon, which strategy would actually create more wealth? To answer that, we need to remove opinions from the equation. No social media advice, no real estate gurus, no stock market influencers, just numbers. We'll use realistic assumptions based on the U.S. market. We'll count every major expense, every dollar invested, every dollar earned. And by the end of this video, you'll see exactly how the math works and why the answer isn't as simple as most people think. Because building wealth isn't about choosing the investment that sounds the most impressive. It's about understanding the investment that leaves you with the most money. So before we compare the results, we first need to understand how each investment actually creates wealth. Let's start with real estate. When people talk about real estate, they usually focus on one number: the home's value. If a house was worth $400,000 30 years ago and it's worth $1.2 million today, it sounds like the owner made $800,000. But that's only part of the story, because buying a home isn't the same as paying its sticker price. Most Americans finance their purchase with a mortgage. That means you're using leverage, borrowing money to control a much larger asset. And leverage can be incredibly powerful. Imagine buying a $500,000 home with a 20% down payment. You invest $100,000 of your own money, while the bank finances the remaining $400,000. If that home appreciates by just 4% per year, its value could nearly triple over the next 30 years. On paper, that's an impressive return. But appreciation isn't the only number that matters. Home ownership comes with ongoing costs that many people underestimate. There's mortgage interest, property taxes, homeowners insurance, maintenance and repairs, and occasionally, major expenses like replacing a roof, renovating a kitchen, or installing a new HVAC system. Financial experts often estimate that maintenance alone can cost around 1% of a home's value each year. On a $500,000 home, that's roughly $5,000 annually, before any unexpected repairs. These costs don't necessarily make real estate a bad investment. They're simply part of the true cost of ownership. At the same time, homeowners are building equity. Every monthly mortgage payment gradually reduces the loan balance. Over time, you own a larger share of the property, and eventually, the home is paid off entirely. So real estate creates wealth in two ways. First, the property may increase in value. Second, each mortgage payment converts debt into equity. That's why millions of Americans consider home ownership one of the most reliable ways to build long-term wealth. But there's another investment that has quietly created enormous wealth over the same period. One that doesn't require fixing broken pipes, paying property taxes, or replacing a roof. And surprisingly, its returns have often rivaled or even exceeded real estate over long periods. Now, we'll see how the stock market builds wealth and why compound growth is one of the most powerful forces in finance. When many people hear the word stock market, they imagine flashing charts, breaking news, and traders shouting as prices rise and fall. But that's not what long-term investing really is. At its core, buying a stock means buying a small ownership stake in a business. If that business grows, your investment grows with it. And if you own an index fund like the S&P 500, you're not betting on one company. You're investing in hundreds of America's largest businesses at the same time. Companies like Apple, Microsoft, Amazon, Nvidia, and many others. Over the past century, the U.S. stock market has returned about 10% per year on average before inflation. Some years, it gains more than 20%. Other years, it loses 30% or more. But over long periods, the market has consistently rewarded patient investors. The biggest reason is something Albert Einstein supposedly called the eighth wonder of the world: compound growth. Imagine investing $1,000. If it earns 10% in 1 year, it becomes $1,100. The following year, you don't earn returns on just your original $1,000. You earn returns on $1,100, then on $1,210, then on $1,331. Year after year, your money begins earning money on the money it has already earned. At first, the growth feels slow, but after decades, the curve becomes dramatically steeper. That's why time is often more valuable than picking the perfect investment. And unlike real estate, investing in stocks doesn't require a large down payment, mortgage approval, or ongoing maintenance. You can start with as little as a few dollars and continue investing every month. Of course, the stock market has its own challenges. Prices can fall sharply. During major crashes, portfolios can lose 20%, 30%, or even 50% of their value. The difference is that history shows those downturns have eventually been followed by recoveries and new highs. For long-term investors, volatility has often been the price paid for higher returns. So now we have two very different wealth-building machines. One uses leverage, home equity, and appreciation. The other relies on ownership, dividends, and the relentless power of compound growth. The question is, what happens when we compare them using the exact same starting money, the exact same timeline, and real-world assumptions? Now it's time to let the numbers decide. Now it's time to answer the question, not with opinions, but with numbers. Let's assume you have $100,000 available today. You have two choices. Option 1. Use it as a 20% down payment on a $500,000 home. Option 2. Invest the entire $100,000 in a low-cost S&P 500 index fund. To keep the comparison fair, we'll also assume that every month you invest the same amount of money that would otherwise go toward building wealth in either strategy. We'll use historical averages, not best-case scenarios. For the home, we'll assume 4% annual appreciation. For the stock market, we'll use a 10% average annual return before inflation. After 30 years, the $500,000 home grows to approximately $1.62 million. And because the mortgage has been fully paid off, the homeowner now owns that property outright. That's an incredible result. But remember, the homeowner also paid hundreds of thousands of dollars in mortgage interest over those 3 decades. Along the way, there were property taxes, homeowners insurance, maintenance, repairs, and other ownership costs that don't increase the home's value but are necessary to keep it. Now let's look at the stock investor. A $100,000 investment growing at an average of 10% per year for 30 years becomes approximately $1.74 million. And that's before adding any additional monthly investments. When regular monthly investing is included, the ending balance becomes even larger because every contribution has years to compound. At first glance, the stock market appears to come out ahead. But this isn't the full picture. Real estate offers something the stock market doesn't: leverage. The homeowner controlled a $500,000 asset with only $100,000 of their own money. If home prices rise faster than expected, leverage can dramatically increase returns on the original investment. On the other hand, leverage also increases risk. If property values fall or mortgage rates rise, the downside becomes much larger. Stocks don't provide that same built-in leverage, but they offer something equally valuable: liquidity. If you need cash tomorrow, selling part of a stock portfolio can take minutes. Selling a house can take weeks or even months, and it often comes with significant transaction costs. So, which investment wins? The answer depends on more than just returns. It depends on the price you pay, the interest rate on your mortgage, how long you stay invested, the local housing market, and whether you continue investing consistently over decades. Now, we'll bring everything together and answer the question that every investor wants to know. If your goal is building long-term wealth, which path gives you the greatest advantage? So, which one wins? After looking at the numbers, one thing becomes clear: there isn't a universal winner. There is only the investment that best matches your financial situation. If your goal is to build wealth while having a place to live, real estate can be an incredible asset. It allows you to use leverage, build equity with every mortgage payment, and potentially benefit from decades of appreciation. But it also requires a long-term commitment. You'll pay interest, property taxes, insurance, maintenance, and unexpected repair bills that can arrive without warning. The stock market is different. It doesn't give you a place to live, but it gives you something equally powerful: ownership in the world's most successful businesses. Historically, investors who stayed disciplined through crashes, recessions, and uncertainty have been rewarded with decades of compound growth. No tenants, no roof replacements, no property tax bills, just consistent investing and patience. The biggest lesson isn't that real estate is better, and it isn't that stocks are better. The real lesson is that time is better. Because whether you invest in property or businesses, the greatest advantage belongs to the person who starts early and stays invested for decades. In fact, many of the wealthiest Americans don't choose one or the other. They own both. They buy real estate for stability, leverage, and cash flow. They invest in stocks for liquidity, diversification, and long-term compound growth. Instead of asking, which investment is perfect? They ask, how can I make both work together? Because wealth isn't built by chasing the next hot investment. It's built by understanding the math, making consistent decisions, and giving those decisions enough time to grow. The truth is, most people spend years debating whether real estate or stocks are better, while investing in neither. And that's the most expensive mistake of all. If this video changed the way you think about investing, remember this. The best investment isn't the one that wins an argument. It's the one you'll stick with for the next 30 years. Because in the end, time doesn't reward the smartest investor. It rewards the most consistent one.